What is a 409A and when do I need one? If you're issuing stock options to employees, you need a 409A. That's the short answer. But let me explain what it actually is. Because a lot of founders get a 409A done without really understanding why. And it does matter. A 409A is an independent valuation of your company's common stock. It set what's called a fair market value, the FMV, of a single share of common stock on a specific date. The number that comes out of a 409A becomes the strike price on your stock options. That's the price your employees have the right to buy shares at. The IRS created Section 409A of the tax code to prevent companies from issuing options at artificially low prices as a way to give employees hidden compensation. If you issue options at or above FMV, the employee doesn't pay tax on the grant, only when they actually sell. If you issue options below FMV, they can owe income tax and penalties immediately, even before they sell anything. That's why the valuation has to come from a qualified independent appraiser. The first time you need one is before you issue your first employee stock options. That's the baseline requirement. After that, you need a refresh after each financing round, annually if no round has occurred, and whenever there's a material event, an acquisition offer, a significant revenue milestone, anything that changes the company's valuation picture. The IRS standard is that a 409A creates a safe harbor, meaning your strike price is resumed correct for 12 months after the valuation date or until a material event. Your employees could face a tax liability they didn't expect and can't control. And that conversation is one of the worst ones you'll ever have as a founder. It usually surfaces at the worst possible time when employees are trying to exercise options ahead of an acquisition or IPO, and there's nothing that they or you can do to fix it retroactively. It also creates a problem for your investors and lawyers in due diligence. Options issued without proper 409A backing are a significant red flag for any fundraise. Cake does 409As in-house. It's $1,500, takes 3 business days, and includes consultation with qualified practitioner. The 409A valuation is in the same platform as your cap table. The valuation history is connected to the grant it supports. So the 409A is one of those things that's invisible when you handle it correctly and very visible when you don't. So if you want to learn more or get one started, go to cakeequity.com.